Stock market, today. A quick look. The stock market is like a giant flea market, but instead of old furniture, we're trading pieces of companies. Imagine walking through a bustling marketplace, but instead of vendors selling fruits and vegetables, they're offering shares of businesses. These shares represent ownership in companies, and they are what we call stocks. These pieces are called stocks. Each stock represents a small fraction of ownership in a company. When you own a stock, you own a tiny part of that company, which means you have a stake in its success or failure. When you buy a stock, you're buying a tiny piece of ownership in that company. This ownership gives you certain rights like voting on important company decisions and receiving a portion of the profits known as dividends if the company decides to distribute them. The stock market is where we buy and sell these stocks. It's a dynamic and ever-changing environment where prices fluctuate based on supply and demand, news, and overall market sentiment. Traders and investors come together to exchange stocks hoping to make a profit. It's open Monday to Friday, and it's how companies raise money and investors, that's you, try to grow their wealth. Companies list their stocks on the market to raise capital for expansion, research, and other business activities. Investors buy these stocks with the hope that their value will increase over time. Think of it as a giant game of buy low, sell high. The goal is to purchase stocks at a lower price and sell them at a higher price, making a profit in the process. However, predicting stock prices can be challenging, and it requires careful analysis and sometimes a bit of luck. But unlike your fantasy football league, this one actually impacts your wallet. The decisions you make in the stock market can have real financial consequences affecting your savings, retirement plans, and overall financial health. So, how do we know if the market is doing well? We look at various indicators and indices that track the performance of the market. These indices give us a snapshot of how different segments of the market are performing. That's where our buddies the Dow Jones, S&P 500, and NASDAQ come in. These indices are like report cards for the stock market, showing us how well the market is doing overall. They track the performance of a select group of stocks and provide a benchmark for investors to compare their own investments against. The Dow Jones Industrial Average, or Dow for short, is like the elder statesman of the stock market. It's been around since 1896. This index tracks just 30 big-name American companies. Think household names like Apple, Coca-Cola, and Boeing. Because it only has 30 companies, it doesn't paint the whole picture of the market. But it's still a good indicator of how large, well-established companies are performing. Next up, the S&P 500. This index tracks 500 of the largest U.S. companies across a bunch of different sectors. Think tech giants, healthcare heavyweights, financial institutions, you name it, the S&P 500 probably has a piece of it. This makes it a broader representation of the overall U.S. stock market compared to the Dow. When people talk about how the market is doing, they're often referring to the S&P 500. Section 4, NASDAQ, where tech lives. Last but not least, we have the NASDAQ composite. This index is all about technology. It's heavily weighted towards companies in the tech sector like Apple, Microsoft, and Amazon. So, if you're hearing buzzwords like artificial intelligence, cloud computing, or electric vehicles, chances are the NASDAQ is feeling the heat. Section 5. What's moving the markets? In this section, we will delve into the various factors that influence the movement of stock market indices. Understanding these factors can help investors make more informed decisions and better navigate the complexities of the financial markets. Now, what makes these indices move up and down? The answer isn't straightforward as multiple elements come into play. These elements can range from economic indicators to geopolitical events and even investor sentiment. Well, a whole bunch of things. Let's break down some of the most significant factors that can cause market fluctuations. The economy. When the economy is strong, people spend money, companies make profits, and stocks tend to go up. Consumer spending is a major driver of economic growth, and when people are confident about their financial future, they are more likely to make purchases, big and small. But if the economy slows down, stocks might take a hit. Economic downturns can lead to reduced consumer spending, lower corporate earnings, and ultimately, declining stock prices. Investors often react to economic data releases, such as GDP growth rates, unemployment figures, and consumer confidence indices. Interest rates. The Federal Reserve, or the Fed, sets interest rates. These rates influence the cost of borrowing money for both consumers and businesses. When the Fed lowers interest rates, it becomes cheaper to take out loans, which can stimulate economic activity and boost the stock market. Low rates make it cheaper to borrow money, which can boost the stock market. Companies can finance expansion projects at a lower cost, and consumers are more likely to take out loans for big-ticket items like homes and cars. High rates? Not so much. When interest rates rise, borrowing costs increase, which can slow down economic growth. Higher rates can also make bonds and other fixed-income investments more attractive compared to stocks, leading to a potential decline in stock prices. Inflation. Nobody likes it when prices go up, especially investors. Inflation erodes purchasing power and can lead to higher costs for businesses. When inflation is high, the cost of goods and services increases, which can squeeze profit margins for companies. High inflation can eat into company profits and make investors nervous. Central banks may respond to high inflation by raising interest rates, which, as we discussed earlier, can have a negative impact on the stock market. Geopolitics, wars, elections, trade deals, all of these can impact the stock market. Political instability or uncertainty can lead to market volatility. For example, trade tensions between major economies can disrupt global supply chains and affect corporate earnings. Remember, uncertainty is the market's least favorite thing. Investors prefer stability and predictability, and when these are lacking, markets can become highly volatile. By staying informed about these various factors, investors can better anticipate market movements and make more strategic investment decisions. Section 6. Futures, a glimpse into tomorrow. Ever wonder what the market might do before it opens? That's where futures come in. Futures are like contracts to buy or sell an asset, like stocks, at a specific price on a future date. They're traded 24/7, even when the regular stock market is closed. By looking at futures, investors try to get a sense of where the market might be headed. But remember, futures aren't crystal balls. They're just one piece of the puzzle. Section 7. So, what's next for stocks? The million-dollar question. With the stock market's inherent volatility, it's a question that keeps investors, analysts, and even casual observers on their toes. The market can be influenced by a myriad of factors, from geopolitical events to technological advancements and even natural disasters. It's a complex web of interdependencies that makes predicting the future of stocks both an art and a science. Predicting the stock market is like trying to predict the weather. You can make educated guesses, but you never know for sure. Just as meteorologists use data from satellites, weather stations, and historical patterns to forecast the weather, financial analysts use economic indicators, company performance metrics, and market trends to make their predictions. However, just like a sudden storm can disrupt a sunny day, unexpected events can send the stock market into a frenzy. That being said, by keeping an eye on the economy, interest rates, inflation, and all that fun stuff, you can start to get a feel for the market's mood. Economic indicators like GDP growth, unemployment rates, and consumer confidence can provide valuable insights. Interest rates set by central banks can influence borrowing costs and investment decisions. Inflation rates can affect purchasing power and corporate profits. All these factors combined can help you gauge the overall health of the market. Remember, investing in the stock market is a marathon, not a sprint. It's about long-term growth and staying the course, even when the market experiences short-term fluctuations. Just like a marathon runner needs endurance, patience, and a well-thought-out strategy, an investor needs to stay focused on their long-term goals, diversify their portfolio, and avoid making impulsive decisions based on short-term market movements. Do your research, stay informed, and don't be afraid to ask for help from a financial advisor. Happy investing. A well-informed investor is a successful investor. Regularly reviewing financial reports, staying updated with market news, and consulting with financial experts can make a significant difference in your investment journey. So, equip yourself with knowledge, stay resilient, and may your investments yield fruitful returns.